Hiya. Today we're going to start the last section of the money management module of the course, which is on taxes and marketing. So there are a number of different taxes you're going to need to know about beyond income tax and national insurance that we've touched on before. So in this section we're going to look at them. That is capital gains tax, VAT, land and buildings tax, and then we're going to look at some of the marketing tools that are used by brands to try and build their own brand and encourage your loyalty. So, first one, capital gains tax. This is for when you buy something and then at some point later on you sell it for a profit. If you have made a significant gain, then you'll be due tax to the government. Things like if you sell an old phone to your friend and you get sort of £50 or £100 for it, then that's not going to be a significant gain, so you wouldn't have to pay tax on that. You get to keep all of that. So what I'd like you to do now is pause the video and then have a look on the internet to find 3 items you would have to pay capital gains tax on. So Google's going to be your friend here. Okay, so pause the video now and we'll see where you're at. Okay, hopefully you found that property that is not your own home is subject to capital gains tax, but if you sell your own home, you don't have to pay capital gains tax. Personal possessions worth over £6,000, excluding cars. Well, hopefully later on you might have found a different number for that allowance there, but we'll come back to that. Business assets, so if you are running a business and sell that asset, then you will have to pay tax on that. Shares that are not in an ISA or a personal equity plan will be subject to capital gains tax if you've made a big profit on them as well. And remember, we talked about ISAs a few weeks ago and before Christmas. Okay, so the rate of capital gains tax you pay will depend on your income. We've touched on that there are different bands that you have to pay with before, so we briefly looked at them. So purposes today, all you need to know that there's 3 different rates of income tax you may pay depending on how much you earn. Basic rate, higher rate, or additional rate. The only 2 that are really going to affect us today are basic rate and higher rate. So, capital gains tax, an example. This is a general example of how we pay capital gains tax. There's an exemption of £11,300, although that may have changed. You'll check that on the government website later on. If you're a standard rate taxpayer, then you'll have to pay 18% on any residential property that's not your own home that you sell, and then 10% on any other asset. That would be only above the exemption. The higher capital gains tax rate, so if you're a higher rate taxpayer, you have to pay more capital gains tax. So you have to pay 28% on residential property and 20% on all other assets. Okay, so we'll have a look at an example now. So Bob, he sold his second property for £45,000 at the standard rate. So he's a standard rate taxpayer, and then he sold that property for £45,000. So we first of all need to have a look at how much he's actually going to have to pay tax on. So there is an exemption of £11,300. So we have to take that away from the £45,000 to see how much of the gain is subject to tax. So £45,000 minus £11,300 is £33,700 that's subject to tax. We identify the rate of tax, so he's a standard rate payer. So it's a standard rate capital gains tax, which means he has to pay 18% on residential property. So 18% of 33,700. So if you remember, changing a percentage into something that we can use in the calculator, we would divide 18 by 100 and then multiply that by 33,700, which gives us £6,066 tax that he'll have to pay. Okay, and another example. How much would Sandra pay in capital gains tax when she sells an antique for £18,500 at the higher rate? So she's a higher rate taxpayer, so it's going to be a different rate. So first thing we need to do, they still get the exemption and the higher rate. So we have £18,500 and we need to subtract our exemption of £11,300, which leaves us with £7,200 that we're due tax on. Well, Sandra's due tax on it. So higher ratepayer, so it's in the second part here, and it's not a house, so it is an other asset, which means we have to pay 20%. So 20% of £7,200, so 20 divided by 100 times 7,200 is £1,440 tax that will be due to the government on the sale of the antique. Okay. Yeah, now today's task. When you go to that website there, so gov.uk/capital gains tax, I'll put that in the team's assignment as well. When you have a look through, there's a step-by-step guide on there from the government telling you how it all works, and it has the most up-to-date figures on it. You're going to need to use those up-to-date figures to then complete task 4 activity 1 in your workbook. So that's the same workbook we were working through in class before Christmas, and that will be today's one. Tomorrow we will have a look at VAT, which you'll have touched on before in previous years, but we'll go through that again just to make sure you're okay with it. Okay, I'll see you tomorrow.